Good afternoon, and welcome to the Boring Millionaire podcast. In this episode of School of Stock, I want to discuss why a stock market being down is actually a good thing. So there's two primary reasons why I would say the stock market being down is a good thing. The first reason is rebalancing. The stock market does need to make sense, and all of the math and all of the averages within the stock market also needs to make sense. So plainly said, it doesn't just go up forever, but keep in mind when days are dark, it's not going to just go down forever either. Those are the only two directions that the market does go in. So if it's not going up, it's going to need to go down. We have been going up since April. So we had a massive decline over the tariff news in the earlier start of the year around April, but since then we have seen the market rebound very, very strongly. From that April low, we have rallied 34%. And what I will say is in the end of June, we also broke through our old all-time high, and we have rallied 10% into record territory from that point. So there comes a point where the market needs to come back to reality. There comes a point where the market needs to rebalance itself. And ultimately, what we see in the market are corrections. Now, the definition of a correction is a 10% decline from the stock market's all-time highs. And within the name itself, it's called a correction. It's not called a disaster. It's not called a catastrophe. It's called a correction because these things need to happen. The stock market very, very often trades well above its one-year average. And more times than not, these corrections will bring us to that one-year average. So even right now on the S&P 500, our one-year average is roughly 60-70. And a 10% fall from where we're at now would basically bring us to around 6120-ish level. So a 10% correction will bring us to our one-year average. And again, it is right above our previous all-time high. So it does make sense for the market to fall. It is a good thing for the market to fall because firstly, as somebody who watches the market every day of my life, it does need to balance out. It does need to come to realistic terms. And sometimes when it just goes on a crazy, crazy rally, there comes a point where it inevitably gives out and it needs to fall to rebalance itself to more practical levels. But within all of this correcting itself lies an opportunity for investors. If you're investing in the stock market, you do want to be buying stocks when they're low. As the age-old saying goes, buy low and sell high. So if the market is crashing and discounting stocks to lower prices, you're buying low. That is the opportunity to be buying low. So at any given point, if the market is showing weakness and we see a couple bad days in a row or over the course of a week or a month, and you see the stock market and other stocks within the stock market lower in price, that is a good thing for an entry buy. So, of course, if you're holding shares of, let's say, Amazon over the past 5 years, and now you see that rally start to halt, and you see a 5 to 10 to 15% decline in your Amazon shares that you're already holding, yeah, of course, when you're looking at the shares you have, nobody wants to be down money. But being that it is a very normal thing within the stock market to have downward cycles, you could look at that 10 or 15% decline in your Amazon shares you currently have, and then look at other shares and say, I love Amazon. I already want to be invested in Amazon. I could now have the opportunity to buy more of these shares at a lower price than what I've seen, say, 3 or 6 months ago. So buying at discounts is always a sure way of making money in the stock market. The objective is to appreciate your money. So if a stock trades around $100 for, let's say, 6 months, some days it's lower around 95, some days it's higher around 102, and it has that range for around 6 months, and then it falls to $85 for a month, you can recognize this $85 share price is certainly cheaper than the $100 or $95 share price that I've seen in months prior. So right there is the opportunity in the stock market. And anytime you see the market down or discounted, it creates that opportunity. So to go back on the corrections that I was talking about, it's very normal in stock market cycles to see at least one correction every 12 months. Sometimes you'll see them within 8 months of each other. Sometimes you'll see them within 16 months of each other. There's no glass ball that you're going to see the exact answer within, but you should expect market corrections when the market is rallying high. And in this given market environment, we have seen an outstanding rally since the April lows. And with that said, I do think there is a coming time where we will see a market decline. So with that in mind, if you see the market down, always feel free to reach out and ask any questions you might have about it. If you're unsure of what stocks to buy during a market decline, feel free to reach out. And also find all other episodes of this podcast on YouTube, Spotify, and Apple Podcasts. My mission is to make sure you understand the market. My mission is to make sure you feel confident about your money. And the next time we see a market decline, I hope you're investing and building your money up, because it's time to start investing in a better financial future for yourself. So thank you for tuning in, and I'll see you next week.